Warren Buffett's a billionaire. If he lives another 15 years, he's likely going to be a trillionaire. What is his secret exactly? He's probably the best investor of all time. And take a guess, what is his average return for the last 50 years? That number? 19.1%. Of course, this is done up to date of 2017. What he has done over the last 53 years has shown that if you compound money, you can actually grow a small sum to an enormously big sum. That is why some people have mentioned that Warren Buffett has made more than 80% of his net worth in the last 10 years. And that goes it, the power of compounding on high investment returns, correct? And that will solve all our financial goals. So take a look at this. If you have 100,000 right now, and if you compound it also for 50 years at 20%, what will it exactly grow to? It will be $976,000. That's $976 million. That's almost $1 billion. Now, do you really believe that your 100,000 will become $1 billion in 50 years? Inherently, I guess the gut feeling is probably no. That is why if you see any advertisements that tell you that you can make 20% returns on your money, there's two reasons for it. A, it cannot be done consistently, or B, it is just outright lying. But maybe that's a bit harsh, so hopefully it's more of A. It cannot be done consistently. Let's look at famed investor Cathie Wood from ARKK Invest. She's mentioned now that she's looking to deliver enormous returns for her investors. Let's look at the top holdings for ARKK with the ticker ARKK. You see that top holdings is Tesla at 9.7%, and third on the list is Teladoc Health at 6.6%. Let's look at Tesla's share price. Over the last 3 years, you realize it's gained 1,720%. That's a fantastic pick. And let's look at the second name that she has on the list. That is Teladoc Health. Now, it's mentioned in January 31st, 2022 that Teladoc Health is on the verge of replacing Tesla as ARK Investors' biggest holding. Cathie Wood is bullish on the telemedicine company. But fast forward to 28 April 2022, you realize that Teladoc has slashed earnings outlooks and has taken a $6.6 billion impairment charge on their Livongo deal. Of course, the share price has taken a big hit. If you see from the market top in February 2021 to right now, in April, you realize that it has dropped more than 80%. And if you were to plot Teladoc's share price against the holdings that ARKK has, on the blue line, that's where the total number of shares held is being reflected. And that has steadily climbed as share prices have gone down. That is good. If you are an investor and you believe in a company, you should actually look to buy cheap and hope for a turnaround. But in this case, the turnaround has not yet arrived, and each increment in stake will cause a bigger loss to the portfolio. So if we plot Tesla's performance against ARKK, we'll see that on a 1-year basis, ARKK has severely underperformed Tesla because Tesla has clocked 26.95%, whereas ARKK has lost 60.47%. If we were to zoom out on a bigger scale, you realize that the difference in performance is even more startling. So is the quick answer just to buy Tesla or one particular stock? After all, Tesla is right now in the limelight. That was where Amazon used to be. And Amazon's name was always conveniently name dropped whenever there was an advertisement for investment courses. So you see over here that Amazon has delivered massive returns over the last 10 years, growing 961%. But as I mentioned, Amazon looks to be out of the limelight right now because it has done nothing over the last 1 year. In fact, it's deteriorated 20.31% in terms of share price. And that is a period where most of big tech have actually seen gains. Could Tesla see the fate of what has happened to Amazon in future? And could Amazon see the fate of what has happened to IBM, which was once a market darling and one of the biggest companies in US? For the last 10 years, IBM has lost 32.48%. The stock market really is not easy. The more you try to chase returns, the more you might make mistakes. And when markets do well, generally everybody is optimistic. And when markets do badly, that is where everybody starts to get pessimistic. That is why Warren Buffett has this saying: it's only when the tide recedes that we understand who is swimming naked. So if an investment performance of 19.1% annually can put anyone as the best investor in the world, why not let's aim for something that's lower, something that you and I, as average retail investors, can look forward to and make financial plans towards. maybe that range should be 4 to 12%. Do note also that Temasek's 20-year average return is only 8% as shown in this screenshot. And most of us, when we invest, we're hoping that these funds will help us in our retirement. We either want to do a financial independence retire early FIRE, or we are really seriously looking to plan for retirement from the age of 60. So let's look exactly what does an investment return of 4 to 12% actually look like for your $100,000. This is a 20-year chart, and you see that the green line is the 4% return. The red line is the 8% return, and the dark blue line is the 12% return. From the looks of this, it's quite obvious that 100,000 cannot grow to a size that you can rely on for retirement. So what we can do is to actually add on a monthly amount, especially if you have active income currently. So the situation is, if you have 100,000 and you're willing to add in $1,000 each month to an investment portfolio, where would you exactly get to? You now see that if you are able to get an 8% return on your investments, you could quite easily hit $1 million in 20 years time. And more conservatively, if you were to achieve 4% real return on your investments, you will hit a mark that's slightly above $500,000 in 20 years time. Both of them seem still quite insufficient. And rather than hoping that we can hit 12% even, why not let's increase the monthly amount that you can contribute for the next 20 years. This is something that you can control. Getting a real return of 12%, you probably have to be fully into equities. But saving up $2,000, that really depends on your employment and your active income potential. And last but not least, it also depends on your expenses, which is something you have full control over. So if we were to change the monthly contribution to $2,000, we will get a new finding of $1 million if you were to achieve 4% real return for 20 years, and $1.6 million if you were to achieve 8% rate of return for 20 years. Let's be a bit prudent and neglect the 12% rate of return, which will start to look very rosy, especially when we are crossing the $2 million mark. I mentioned in a previous video that it's probably enough for you to retire on if you have $1.6 million. Check that tutorial out, and I'll leave the thumbnail also towards the end of this tutorial. Now let's stretch a bit on the variable on what you can control. Could you save $3,000 a month? That will bring it to $36,000 annually. And to derive that level of savings, you definitely need to have a tight expenses as well as a good enough primary income. But if you see anybody that has done financial independence retire early, FIRE, they have all managed to save a substantial amount per month, and $3,000 is not a big stretch. So let's go ahead and change this to $3,000, and we'll see that our findings will deliver us an investment portfolio worth $1.291 million with a 4% return for 20 years and $2.113 million with a portfolio return of 8% per annum. And a range between these two numbers certainly look like something that can give you a meaningful size for your retirement. Anything above that certainly looks very comfortable. And that goes to show, to build a more predictable approach to get to your financial independence, focus more on how much you can invest and go with a slow and steady approach. To get 4% real return, it's quite easy. In Singapore, we have this pension scheme, CPF special account. That itself will give you 4% per annum already. And you can consider your CPF special account as part of this calculation. So if you benefited coming to here, help me smash your like button and press on subscribe, especially if you like topics on retirement planning and investments. And since you stuck to me till here, let me share with you a bonus point, which is if you still believe that $1.291 million in 20 years time may not be sufficient, maybe because you are now at the age of 30 only and 20 years later is at the age of 50. What can you do in order to have a more predictable pot for you to retire on? Simply use this idea of semi-retirement. That is when you actually work to earn the level of expenses that you need to spend and you do not need to contribute any more to your own retirement pot. Many have also termed this coast FIRE. You can check it out. So what would happen is that if you have $1.291 million, simply invest it at 4% per annum and compound it for a further 10 years. In the meantime, look for employment income that can help you in your day-to-day expenses so that you don't need to deplete your retirement pot. And at the age of 50, you probably still have a lot of active energy to find some small level of employment income. So if we were to compound this for 10 years, you realize that you can reach a pot of more than $1.6 million again, and that may be all you need to have a fruitful retirement. And to end things with, I'd like to quote from Charlie Munger. It's in the nature of stock markets to go way down from time to time. There is no system to avoid bad markets. You can't do it unless you try to time the market, which is seriously dumb thing to do. Conservative investing with steady savings without expecting miracles is the way to go. So with that, I'll sign off and invite you to some of my previous tutorials on semi-retirement. Maybe it can spur you further. And as always, if you're looking for more advice on retirement planning and investments, check my links below. I provide one-to-one advisory work on a fee, and I can tailor a solution that fits your needs. With that, I'll sign off. Take care and goodbye.